Welcome, everyone. Good morning. Good morning. We got the chat up there, so go ahead and drop a comment when you tune in. I hope everyone had a great weekend. All right, there we go. Some people checking in. Good morning. Great to be alive. I love that comment. Absolutely. On a Monday morning, it's time to get to it. Monday's a great opportunity. It's not a bad day, it's a good day. It's time to wake up and get to work. All right, give us just a second here. We're just waiting to go live on all the different platforms, so just hang tight. All right, it looks like we are good to go. So we can take the chat out of there. Welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And today, our deep dive topic is going to be one of the ones that we do the most of as far as non-QM loans go. We very much specialize in this, which is short-term rental properties. So after we go through the rates today, Jose is going to go into a deep dive of some short-term rental property solutions that we provide here at the Mortgage Calculator. But before we get into that, like we do every morning, we're going to go ahead and go through the rates of the different programs so you can see the actual live rates from today, which is March 27th. It's just after 11 a.m. So, Nick, why don't we go ahead and pull up the quoting tool so that we can show everybody what the live rates are today.
All right, thank you, sir. Let me go ahead and switch my screen and we'll get started. So as Kyle mentioned, this is our live pricing tool for our team of mortgage professionals. If you'd like a full loan estimate, please get with our team. We have over 300 licensed loan officers in pretty much every state, and we can do loans for primary and second homes in 22 states. And we can do our DSCR business purpose loans, which is going to be part of the deep dive topic here with Jose, in pretty much all states. So we're going to use our pricing tool today just to check out the general pricing and APRs that will be valid for today, March 27th, just after 11 a.m. Eastern. And we are going to set up some basic scenarios. So we'll start with a nice, easy loan amount of $400,000. We will set up an LTV of 80. That means 80% loan, 20% down payment for all of our scenarios today. We're going to ask the computer to find the best rate at 99 price. What that means is one discount point in cost. Most of our customers are asking to buy down the rate a little bit. So that is typically our typical scenario these days. And we're going to go through our 3 examples for a primary home. We'll start with our conforming conventional, then we'll check out our FHA rates, and then we will go into our expanded guidelines, aka non-QM, where we have over 5,000 loan programs that use alternative income documentation. If you are a veteran and qualify for a VA loan, we appreciate you and we would be happy to quote you up. But since not everybody is an eligible veteran, we don't do that live every day. And same with USDA. USDA is only for properties in a rural eligible USDA area. So if you happen to be shopping in one of those areas, please let us know and we'd be happy to quote it. But let's start with our conventional programs. We will set it as a purchase, 30-year fixed standard loan, primary home occupancy, single family home, 1 unit, state of Florida, county Miami-Dade. That's where our office is. And for all of our demos today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So these are going to be our settings, and let's check out our rates this morning. So looks like it's about the same as it was last week, which is good, right? Because it's been down. So this is a great opportunity. We are at 6.5 rate on our conforming programs for 0.875 in discount point here for an APR of 6.672. So some great options here for our borrowers that qualify for conventional and conforming. And always make sure to compare your APRs. That takes all of your cost of borrowing into account so we can easily compare across programs. So if any reason our borrower doesn't qualify for conventional, typically the next option, let's go back to the pricer, is going to be an FHA. So we'll set up the same exact scenario, and under loan type, we'll just switch to FHA so we can compare our FHA programs. Everything else will stay exactly the same. So we'll see here, FHA again, pretty much the same as it was last week, which is low, which is good, right? So right now, the best option the computer found was 5.625 rate for 0.875 in discount points and the APR of 6.223. Remember, there are additional costs for FHA. So while it does have a low rate, the APRs are a little bit higher. But remember, for conventional, we were at, I believe it was 6.6 something. Now we're at 6.223. So not very often, just recently, we've seen that FHA in this scenario is actually a little bit cheaper in this case, even though it does have an upfront mortgage insurance and a yearly mortgage insurance, but those have been lowered recently. So a great option for our borrowers. Always recommend you look at conventional and FHA and compare them side by side. Now, for our final demo for a primary home, we want to set up the same exact scenario. But if for any reason our borrower would not be able to qualify for conventional or FHA, whether it's a DTI issue or any other types of issues, that's where our non-QM, aka expanded guidelines programs, come in. So these allow us to use alternative income verification as well as a bunch of other basically exceptions to the standard guidelines. That's why we call it expanded guidelines. So tons of options under here. We'll keep everything else the same. However, you notice we have a new option for income verification. So full doc would be 2 years of tax returns, which is typically what we use for conventional or FHA. So the point of going to expanded guidelines would typically be to use a alternative income, 1 year alt doc, 2 year alt doc, asset related. Business bank statement is very popular. DSCR we'll go through in a minute for investment properties. But our most popular program for a non-QM program is going to be a personal bank statement 12-month program. And that's going to be for our self-employed borrowers, because many times our self-employed borrowers, when they file 2 years of tax returns, they have various write-offs and things that may affect their income when we analyze it through traditional means. So in this case, we will use non-traditional means, non-QM, to use 12 months of bank statements to analyze those and determine a debt-to-income ratio of 40% using those 12 months of bank statements. So if we actually look at a self-employed borrower's cash situation in their bank, typically we can qualify them for much more homes. So a borrower who would not otherwise qualify at all or needs to qualify for more income, aka more purchase power, can use these programs to expand their options. So we love to offer these as well to compare them side by side. So these non-QM programs will be a little bit higher rates, but again, this would be for a borrower who would not otherwise have options. So here we have a couple different options. Looks like the best one is 7.25 rate for 1 discount point in cost and an APR of 7.297. So remember the APRs on the conventional were at 6.7, I believe it was 6.5, something like that. So a little bit higher than that. And then remember the FHA was 6.22, I believe. So it's about 1% higher in APR than FHA. But remember, these would be for a borrower who would not otherwise qualify. So there's tons of different options here using bank statements. You see we have dozens and dozens of programs. Some at a little bit higher rate may allow things like a foreclosure recently or a bankruptcy or other things that fall outside of the traditional guidelines. So not only do we use these non-QM programs to qualify borrowers for more income, but we also have a lot of other flexibility here. So let's go back for our final scenarios here. Go back to the pricing tool. And we want to always compare our investment property programs. So Real quickly here, we'll set up the same exact scenario, 80% loan to value, 20% down payment. Tell the computer to look for the best rate at one discount point in cost. And with investment properties, there's really only two options. We have our conforming conventional programs and our non-QM programs. FHA, VA, and USDA are only for primary homes. So we'll quickly compare our two available options here. So conforming, we'll keep everything else the same as our other scenarios. And let's check out the difference when we look at an investment property. Come on. Sorry, I was frozen there for a minute. So you notice here there are some great rates, 6.75. However, the GSEs have added additional loan level price adjustments. So you see the computer was unable to find an option for one discount point in cost. So we say this every morning, but unfortunately, just with the way conventional is right now, there are additional points. So 3.625 in points and costs was our best combination for the lowest APR of 7.014. So great low APRs here, but many times our investors, especially ones that have multiple properties, do not want to pay this many discount points, right? $14,500 is a lot of money out of pocket. Our investors could deploy in another investment, right? Purchase another property or rehab another property, whatever they're doing. So many times our investors are asking, great, these are great conforming options, but where can I get less discount points? You see here, 7.125 going up in rate a little less discount points. Great options, so we love to give options. However, to really give the lower discount points, we need to use a whole different program, and that would be our non-QM programs for investment properties. So let's set up our final scenario here today for an investment property, 80% loan to value, and we'll switch to expanded guidelines here. Now we have two new options. First, we have our income verification, and our most popular income verification for an investment property is going to be our DSCR program. And that's because it doesn't require any income from our borrower or employment from our borrower. We're simply going to use the estimated rental income from the property to determine if that can cover the mortgage payment, the PITIA of this loan we're proposing. So anything that typically covers the payment, where the rents can cover the payment, is a ratio greater than 1. And we have a ton of options for that. And we even have options where the property may not quite cash flow and has a ratio under 1. And we have options for that. So please get with our team. They'll navigate you through all these options. But let's set up our final setting here for prepayment penalty. Non-QM investment properties typically always have a prepayment. We can select 0. However, that will be more expensive and limit our loan program options. So we always set it to 3-year. That's a pretty standard prepayment penalty. If you do want to hold a property, if your borrower wants to hold a property, you can set 5 years and save a little bit of money. But 3 years is going to give us the most amount of program options and be the most common option. So we'll always set that up. And let's check out our DSCR rates today. So some great options here. Obviously, non-QM is going to be a little bit higher in rate and cost. However, you see the 7.875 rate here at the top for 0.975 in discount points. So now we're in the range of where we wanted to be, 1 discount point, and a final APR of 7.921. So the conventional loan programs were just over 7 on the APR. Now we have our DSCR in the high 7s, so very comparable. And again, our investor in this case is going to save over $10,000 out of pocket, which they can then deploy into another investment. So that's the main point here, is that we want to give our investors options, and we have a ton of options here under DSCR. See here, just dozens of different programs with different DSCR values. You notice this one is for under 1 ratio, so this would be for a property that doesn't quite cash flow. You see a little bit higher rate. Some of these programs may allow things like short-term rental income, which is what Jose is going to get into. Jose is going to pick out the programs here that may be a little bit higher rates, but they allow us to use short-term rental income so we can qualify short-term properties that wouldn't otherwise qualify. So we absolutely love these DSCR programs. There's a ton of them and a ton of different options. Please get with our team, and we'd be happy to give you a few different quotes on a few different options here. Now, let me switch my screen, and we will go into our deep dive with Jose on our topic for today, short-term rental property loans. So typically we use our DSCR program for this, which I just went over a second ago. So it's a good segue here. And basically, a short term rental property loan would allow us, in most cases, to use short term rental property income in order to qualify that property. So, not many programs do, but fortunately, that is our flagship product here. And we have dozens of options that are available for our borrowers to use short term rental income when it is necessary. So, Jose Gonzalez, our sales manager with 27 years of experience. Why don't you go ahead and introduce it, Jose, and then we'll share your screen.
Sure. Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Yes, the debt service coverage ratio, also known, which is an acronym. I mean, DSCR is an acronym for debt service coverage ratio, is an actual calculation where you divide the gross monthly rent by the total housing expense, principal, interest, taxes, and insurance, and if applicable, association fee. However, that is where it gets interesting because it is exactly how we arrive at the 1007 or at the rent, at the gross market rent, which does allow us to employ all the different programs. Because as we all know, no two DSCR programs are created alike. They all have different guidelines. All those different guidelines have different twists to them, which is what allows us to get creative when we analyze these purchases to see what is the best course of action for the borrower. The traditional sense of arriving at the income for the DSCR is using the 1007 market rent schedule if it's a one unit property, or the 216 operating and expense report if it's a 2 to 4 unit property. So that is one way to do it. And another way to do it is short term rental revenue from the last 12 months. It can be either from the owner, current owner of the property, if it's a purchase, or it could be from the owner of the property if it's a refinance. So they do require usually 12 months worth of that. They add it up, average it, and then usually apply some type of an adjustment anywhere from 25 to 30% of that amount, depending on, again, which guideline we are reviewing. And then the third option, which is the most esoteric of them all, is the AIR DNA short term rental revenue projections. It is a projection for that property for the area that it is in. Now, mind you, there have to be similar type properties in the general vicinity. They're not going to allow you, just like in an appraisal, drawing comparables from miles and miles and miles away, just because that's the one that was able to work for the numbers that you needed. It's just like an appraisal, stuff that makes sense. And then usually the the Air DNA report will be run by underwriting. So they'll run it to confirm all the information. So keep that in mind. If you are considering Air DNA, there will, you can run it on your own, obviously, and see what is available because that is a database that is available for a subscription. So, due to those different ways of arriving at the income, is how we can get so creative because we have so many DSCR options. So, in the first option that I have here, it is a 20% down option. Now, mind you, the what you're going to find when you're using Air DNA is that there may be a 5% LTV reduction for Air DNA because it is projections. It is, way out there in the scheme of things of figuring out income. So due to a little bit riskier method, there may be a 5% LTV reduction on that. So in this scenario here, we have 9.625 as the lowest cost option. This is for a $600,000 loan. And we have
Can you
8 point.
can you zoom in a
Zoom
touch
in?
there? Yeah.
Sure, sure. Sorry about that. Let's make that a little bigger here.
Perfect. Thank you.
All right. So we have 9.625 lowest cost option and 8.75% as the lowest rate option that we can still offer and still be in compliance, just under 3 points on that one. And that's with 20% down one unit property. So now to compare rates here, we have, and this is another Air DNA option that allows Air DNA plus short-term revenue reports or 1007. So you will note rate gets substantially better here. 9% is giving us a lender credit, with the lowest cost option being 8%. And the other scenario had 8.75. So roughly 3/4% lower rate. So now I have a non-Air DNA option, 20% down, does use short-term rental revenue reports for the last 12 months or long-term rent from the 1007, whichever works. Right? So this option is 20% down as well. So you will note here 9.875 is your lowest cost option, and 8.125 is your lowest rate option. So now let me show you a refinance just so you can have an idea. We can go up to 75% LTV on this. Again, if you are using, well, actually for the refi, that's a typo there. The refi does not allow Air DNA. You would be using for the refi either short-term rental revenue reports or long-term rent. However, if the appraiser does, for this particular option now, if the appraiser can put short-term rental comps on the appraisal, it will be used on this one for the refi as well as on this one. If the appraiser can put the 1007 actual short-term rental comps on the 1007, it will be applicable for this 20% down option as well. We do have options that do accept short-term rental comps as long as the appraiser puts them directly on the 1007. Now, we all know that's a little bit of a challenge, but we have had it. We have had it happen. So this is going back to our 25% or 75% LTV cash out. Now I'm going to throw a little bit of a twist here because everybody's always honing in on DSCR for short-term rental, DSCR, but there is another option because I always like to mix it around a bit. We can actually do full doc second home on a short-term rental property at an 85% LTV. Wow. Yes. Why is that? Because we read into the guidelines and we find out what is possible, right? On a second home, the borrower only has to occupy the property for 2 weeks out of the year. So if the property is in an area that could lend itself to being a second home, which is what you would really want a short-term rental to be, because it's going to be sort of, where people want to stay and have fun. That's usually what a second home is about, right? So when you're using short-term rental on a property, you do not have a permanent lease, which is what a second home does not allow you to do. Second home, you cannot have a permanent lease. You can't have a second home and lease it out long-term rent and never occupy the property. That would be a violation of the mortgage agreement, and you could result in your loan being foreclosed upon. However, second home, short-term rental is a possibility. It is full doc. It's not DSCR, but we do have full doc borrowers buying second homes, right? So right here now, just by us reading the guidelines, looking into it, understanding what we're reading, and if our borrower obviously is full doc, doesn't hurt to ask. Just because they're coming in for a DSCR loan doesn't mean they don't have, tax returns and they don't qualify. They just click on our cool DSCR ad. They're like, what is this program about? We tell them what it's about. We send them the quotes, but then we also do our consulting job and find out all the parameters of the loan to make sure that full doc is not an option, because if it is an option, it would probably be the lowest cost option for this scenario, especially because we're looking at 8.25 with a lender credit of $1,594 and taking it down all the way to 7.125 rate. That's amazing.
And that's at 85, yeah?
Yes. Yes, 85% LTV. So again, cannot assume anything. We have to go through the processes of always trying to offer the lowest cost option to the borrower. And that's not just necessarily the lowest cost rate of the DSCRs, it is the lowest cost option. So if they qualify full doc, that's the option by law that we have to go, unless the customer just absolutely refuses, sends you an email, no, Jose, I don't want to do full doc for a multitude of reasons. They give you, fine, we did our job. Borrower has an option to do what they want to do. We're okay, and let's proceed. But I would believe that if they are full doc and if they are able to buy it as a second home, uh, no occupancy, fraud involved or anything like that, then this is an amazing option for your borrower. Most of you may not have thought about this option, but it is out there. Keep it in mind.
Absolutely great. So yeah, just like we always do here at the Mortgage Calculator, as Jose went through, we can consult our borrowers through all of the different options. So not only do our loan officers, not only can they do conventional FHA, VA, USDA, like Nick just showed you, but everything in between and things like this, right? The DSCR program, find the different programs that fit, all the way to fix and flip and ground up construction. We essentially have it all. So if you want to connect with one of our loan officers, we have over 300 loan officers all across the country, licensed in 22 states. And these type of loans that we discussed today, we can do in almost every state. So visit us at themortgagecalculator.com. We can pair you with one of our loan officer consultants, or you can email us info@themortgagecalculator.com. We do this show every single weekday at 11 a.m. Eastern, so you can tune in and see how the rates are going up and down and reacting to the market. And then we do a deep dive into a different topic every day, just like we did today with the short-term rental. So thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in. And we hope to see you all tomorrow at 11 a.m. Eastern again. Everybody take care.
Thanks, everybody.
Thank you, everybody.